Hi, welcome back to my class. Today we will discuss about journal. There will be 4 subtopics. First, meaning and features. Second, advantage and objective of journal. Third, performance of journal. And last one, journalizing the entries. Meaning and features. The word journal has been derived from the French word jour. Jour means day, so journal means daily. Transactions are recorded daily in journal and hence it has been named so. It is a book of original entry to record chronologically and in details the various transactions of a trader. It is also known day book because it contains the account of every day's transaction. Journal has the following features. First, journal is the first successful step of double entry system. A transaction is recorded first of all in the journal, so the journal is called the book of original entry. Second, a transaction is recorded on the same day it takes place, so journal is called day book. Third, transactions are recorded chronologically, so journal is called chronological book. Fourth, for each transaction, the names of the two concerned accounts indicating which is debited and which is credited are clearly written into consecutive lines. This makes ledger posting easy. This is why journal is called assistant to ledger or subsidiary book. Fifth, narration is written below each entry. Last one, the amount is written in the last two columns. Debit amount in debit column and credit amount in credit column. Objective of an entry. While recording transaction in journal, the following two objects must be aimed at. First, that each entry in the journal should be clear that at any future time we may, without the aid of memory, perceive the exact nature of the transaction. Last one, that each transaction should be classified that we might easily obtain the aggregate effect of such transaction at the end of a certain period. Advantages of journal. First, each transaction is recorded as soon as it takes place, so there is no possibility of any transaction being omitted from the books of account. Second, since the transactions are kept recorded in journal chronologically with narration, it can be easily ascertained when and why a transaction has taken place. Third, for each and every transaction, which of the two concerned accounts will be debited and which account credited are clearly written in journal, so there is no possibility of committing any mistake in writing ledger. Fourth, since all the debits of transaction are recorded in journal, it is not necessary to repeat them in ledger. As a result, ledger is kept tidy and brief. Fourth, journal shows the complete story of a transaction in one entry. Last one, any mistake in ledger can be easily detected with help of journal. Accounting basic tips. To determine how you would record the transaction, you have to determine what kind of account is being affected and if it was increase or decrease. There will be 4 types of account: asset, liabilities, income, and expenses. Increasing in assets, we have to put in debit. Liabilities. Decreasing in liabilities, we have to put in debit. Income, decreasing in income, we have to put in debit. And last one, expenses. Increasing in expenses, we will put in debit. Form of journal. There will be 5 columns. First column is meant for writing the date of transaction. Second column is used for recording the names of the two accounts affected by transaction. Third column is meant for noting the number of the page of the ledger on which the particular account appears in that book. Fourth column shows the amount to be debited to the account name. Fifth column shows the amount to be credited to the account stated. So now let's have exercise. Company A was incorporated on January 1st, 2020 with an initial capital of 5,000 shares of common stock having $20 per value. During the first month of its operation, the company engaged in the following transaction. January 2nd, an amount of $36,000 was paid as advance rent for 3 months, and January 3rd paid $60,000 cash on the purchase of equipment costing $80,000. The remaining amount was recognized as a 1-year note payable with an interest rate of 9%. So now, how to record the transaction? Let's back to the January 1st. It's mentioned that the company sell 5,000 common stock with the price $20 per value. So in January 1st, company will get cash $100,000 from selling common stock, right? Cash a part of asset. Increasing in asset, we have to put in debit. So in the journal, we can write cash in debit $100,000 and common stock in credit $100,000. 2nd January transaction. An amount of $36,000 was paid as advance rent for 3 months. In the 2nd January, company pay one-off expenses, right? To pay rent in advance. So we can write prepaid rent because we pay 3 months in advance. So we can write prepaid expense $36,000 in debit and cash $36,000 in credit. Expenses. Increasing in expenses, we have to put in debit. Pay rent in advance, a part of expenses. So we can put in debit and cash. Decreasing in cash, we have to put in credit. So cash $36,000 in credit. Last transaction on January 3rd. Paid $60,000 cash on the purchase of equipment costing $80,000. The remaining amount was recognized as a 1-year note payable with an interest rate of 9%. January 3rd means we will have more equipment. Equipment will be increased. So we have to put equipment in debit, and then we pay cash $60,000. Means our asset will be decreased. So we can put cash in credit, and then the rest of $20,000 it will be notes payable, right? So we have to put in credit $20,000. Okay, that's all for today. Bye. Thank you for watching.